Everyone wants to be in the trade before the big move happens. But most traders get trapped trying to predict the bottom or guess the top. What if you didn't have to guess? What if you just followed? Welcome back. Today, we are decoding the grandfather of all algorithmic trading concepts, the trend-following strategy. It is the logic behind some of the biggest hedge funds in the world, and it's surprisingly simple to code. We're going to break down the concept, look at the brutal pros and cons, and finally, I'll show you a sample logic you can test on Indian markets. Let's dive in. Trend following isn't about predicting the future, it's about reacting to the present. Think of it as Newton's first law applied to the stock market. An object in motion tends to stay in motion. The algorithm doesn't care why the market is moving, it doesn't care about the news, the budget, or the PE ratio. It only cares that the price is moving up and it wants to hop on the bus. The core logic is simple. Number one, identify the trend. Is the price higher than it was X days ago? Number two, entry. Buy when momentum is confirmed. And number three, exit. Sell only when the trend definitely bends. Now, before you rush to code this, you need to know the reality. Trend following is psychologically hard. Let's start with the pros. You capture the outliers. You never miss a bull market. If Nifty rallies 2,000 points, your algo will be in it. It offers a big risk-to-reward ratio. You might lose 5 small trades, but one big winning trade can cover all losses and more. But here are the cons. The whipsaw. In a market that isn't moving, a trend-following algo will buy at the top of the range and sell at the bottom, over and over again. You will face a low win rate, often 30 to 40%. The magic is that your wins are huge, but your patience will be tested. Let's look at a classic Hello World example of this concept, the moving average crossover. Here is the logic for an Indian market context. We use the Nifty 50 futures on a 15-minute time frame. We use 2 indicators, a fast 50-period exponential moving average and a slow 200-period exponential moving average. The rules are as follows. Long entry. Buy when the 50 EMA crosses above the 200 EMA. This signals short-term momentum is outpacing the long-term average. Short entry, sell when the 50 EMA crosses below the 200 EMA. For the stop loss, use a trailing stop, like Supertrend, to protect profits if the trend reverses sharply. Remember, this is just a concept. In the real world, you would add filters to reduce the false signals. Trend following is powerful, but it requires discipline to handle the losing streaks. Remember, in algo trading, the glitch is usually human emotion interfering with the code. Please listen to the following disclaimer carefully. Registration granted by SEBI, membership of BASL, and certification from NISM in no way guarantee performance of the intermediary or provide any assurance of returns to investors. This content is for educational purposes only. The strategy discussed, specifically the moving average crossover, is strictly for illustrative purposes. It does not constitute investment advice, trading tips, or a recommendation to buy or sell any asset. Investments in the securities market are subject to market risks. Read all the related documents carefully before investing. Algorithmic trading involves unique risks, including system failure, latency, and execution errors. Past performance is not indicative of future results. There is no guarantee of profits or protection from losses in stock market trading. Please consult a SEBI-registered investment advisor before making any financial decisions. Trade safe, code smart, and see you in the next one.